The room is quiet, not a trading floor, not a bank vault, just a screen glowing at 2 a.m. somewhere. A government just borrowed another $100 billion. No parade, no alarm, no one knocks on your door. But interest starts ticking immediately. Here's the uncomfortable question most people never ask. Who is actually getting paid? Because when governments borrow trillions, the interest doesn't vanish into the air. It doesn't go to the system. It doesn't go to some abstract concept called the market. It goes to someone. And once you see who that someone really is, the entire debt debate changes. Right now, this matters more than ever. Governments across the world are drowning in debt. The United States alone owes more than $30 trillion. Interest payments are now one of the biggest line items in the federal budget, bigger than education, bigger than infrastructure, closing in on defense. And yet, when politicians talk about debt, they argue about spending, about taxes, about deficits. They almost never talk about the interest. That silence isn't accidental, because interest is where the real story lives. When a government needs money, it doesn't go to a bank like you do. It issues bonds, treasury bonds, notes, bills. These are just IOUs. The government says, lend me money today, and I'll pay you back later with interest. Those bonds get sold at auctions. And here's the first twist. The buyers are not who most people imagine. Yes, some are foreign governments. Japan, China, oil exporting countries parking surplus cash. But the biggest buyers are much closer to home. Pension funds, insurance companies, banks, mutual funds, and increasingly the central bank itself. Your retirement fund owns government debt. Your insurance premiums are invested in it. Your bank's balance sheet depends on it. So when the government pays interest, a large chunk goes straight back into the financial system you're already part of. At first, that sounds almost comforting. It feels circular, harmless, like the government owes money to itself. But that's only half the truth, because ownership is not evenly distributed. The richest 10% of households own the majority of bonds, directly or indirectly. The poorest half own almost none. So when interest checks go out, they don't go to everyone. They flow upward, quietly, reliably, every year. Now here's where it gets more interesting. What happens when interest rates rise? Suddenly, those interest payments explode. A bond issued at 1% is cheap. A bond issued at 5% is not. As old debt rolls over, governments have to refinance at higher rates. Same principle, much bigger interest bill. That extra money has to come from somewhere. Taxes, inflation, or more borrowing. This is the hidden mechanism most people miss, borrowing to pay interest. New debt issued to service old debt. It sounds reckless. It sounds unsustainable. And yet, it's normal. Governments have been doing this for decades, because as long as the economy grows and inflation slowly erodes the real value of the debt, the system limps forward until it doesn't. Now let's talk about the biggest, quietest player in the room, the central bank. When interest rates are low and markets wobble, central banks step in. They buy government bonds, massive amounts of them. This is called quantitative easing. But don't let the name scare you. It's basically this. The government borrows money. The central bank creates money. The central bank buys the debt. So who gets the interest? The central bank does. But central banks don't operate like normal investors. After expenses, they often send their profits back to the government, which sounds like a neat trick, until rates go up. When rates rise fast, central banks can start losing money on those bonds. In some cases, they pay more interest on reserves than they earn on assets. so the profits disappear. Sometimes they turn into losses, which governments then quietly cover. So the idea that we owe the debt to ourselves starts to crack. Because someone is still paying, and it's not voluntary. Now let's address the most common myth. Foreigners own our debt. Yes, some do. But even in the United States, foreign holders own less than a third of total debt, and that share has been shrinking. The majority is domestic, meaning interest payments stay inside the country. But staying inside the country doesn't mean staying inside your wallet. It means flowing to asset owners, bondholders, institutions, people with capital. If you don't own financial assets, you don't receive interest. You just help fund it through taxes, through higher prices, through slower growth. This is where the irony kicks in. Government debt is sold as a tool to stabilize the economy, to help people, to smooth crises. And in many ways, it does. But the interest mechanism quietly transfers wealth upward over time. Not through corruption, not through conspiracy, through math. Simple, boring, ruthless math. Now zoom out. Why don't markets panic if this is so fragile? Because debt isn't judged like household debt. Governments don't need to pay it off. They need to service it. As long as investors believe the government can roll its debt indefinitely, the game continues. Confidence is the real collateral. Lose that, and interest rates spike. Borrowing costs explode. Choices get ugly. Raise taxes sharply. Cut spending brutally. Or inflate the currency. None of these are painless. This is why interest matters more than debt totals. A country with high debt and low interest is comfortable. A country with moderate debt and high interest is in trouble. And, right now, interest is rising everywhere. Which brings us back to the original question. Who actually gets the interest? Not some faceless entity, not the market, not the future. It goes to people and institutions that already own capital. It rewards past wealth with guaranteed income. It compounds inequality quietly, year after year. And the bill, it gets spread thinly across millions of people who never agreed to the deal. This doesn't mean debt is evil, or that borrowing should stop, or that interest payments are a scam. It means the system has winners by design, and as the numbers grow larger, those design choices matter more. So here's the unresolved question to sit with. As interest becomes one of the largest expenses governments face, as more public money flows to bondholders instead of services, and as fewer people actually receive those payments, how long can a system survive where borrowing is collective, but the interest is private? No collapse prediction, no neat ending, just a question. And once you see it, it's hard to unsee.